Okay, let's talk about organizational structure. Organizational structure is basically how the different tasks are organized or allocated in the organization, and it gives the organization shape, one can say. So this, again, organizational structure, how the jobs are allocated, how the tasks of the employees are allocated, and of course, employees tend to be an expense of the firm. They also drive revenue as well, but a relationship between the revenue and the firm expenses lead to the earnings and firm value. So, in a certain respect, organizational structure has an impact on firm value. We could also say that the organizational structure should follow the strategy of the organization. Here's an example of an organizational chart. This is a functional chart because we have the finances in one area, we have the marketing under one person, we have the operations under one person, with the president reporting to the board of directors. And we'll talk about that a little bit later in another lecture. Again, the organizational chart is that artifact that we're most familiar with, and it shows the interaction between and among the employees and their responsibility. The chain of command is a term that you really should know. What the chain of command is basically shows the line of responsibility and the line of reporting from the top of the organization through the bottom of the organization. A continuous line from the top to the bottom. The president or chief executive officer has the ultimate responsibility for the firm's success, and he is appointed or selected by the board of directors, and the board of directors are elected by the shareholders. So it's his responsibility or her responsibility on a day-to-day basis to run the business, and he or she often then delegates to vice presidents that oversee broad areas of responsibility, sometimes divisions, and that sort of thing. And the vice presidents, again, because they're in the chain of command, report back to the president. As I said before, the board of directors have responsibility and also liability for monitoring activities of the firm's president and other high-level managers, and the directors are elected by the shareholders and serve as representatives for the shareholders. In some countries, in some jurisdictions, the board of directors also represent other broader stakeholders. The board of directors can be outside managers, or they can be inside managers of the firm. And usually there's some sort of mix of both of them. And the shareholders often reward the board of directors in terms of their compensation with stock. And the idea is that if they have ownership in the firm, the directors, that they will serve the interests of the firm's shareholders. It doesn't exactly work that way all the time, but that at least is the theory. And if we're building small, medium-sized businesses, then that more closely holds. So the board, as I said, is ultimately responsible for the CEO, but the board does not get involved in day-to-day activities of the firm. They usually are more involved in major financial and major strategic sorts of issues. Mergers and acquisitions, again, replacing the CEO, restructuring the organization. And as it says here, is that sometimes conflicts can prevent board members from making decisions that are in the best interests of the shareholders. When that happens too much, of course, then the board of director or the shareholders have to come to some sort of decision and replace that particular member. This is just a quick a survey. It just shows that who makes up the board of small firms. And as we see, almost 70% of the small, medium-sized boards are made up of executives of other firms, entrepreneurs and managers in other sorts of firms. And then a little over a third by major investors in the firm. And retired executives is a substantial part. Now, it's not clear are these retired executives also investors of the firm, but oftentimes angel investors, equity providers, informal equity providers, are retired business executives or entrepreneurs, and they often sit on boards of directors as well. And then you see we have attorneys, accountants, bankers, and consultants, or kind of service providers that provide various services to companies. They often have seats on boards as well. Other elements of organizational structure: internal auditor. Now, this internal auditor, as it says, responsible for making sure that the firm follows the guidelines. Oftentimes, the internal auditor reports directly to the audit committee, which is a subcommittee of the board of directors. Additionally, there's often an external auditor, and that auditor works for the board of directors as well. Span of control. Span of control is something that you should know. It's basically how many employees can be managed by a single manager or supervisor. You have a narrow span of control if you have few employees reporting to you, and you have a wide span of control if you have many. Now, the width of that span of control varies based upon type of job, location, and technology, and that sort of thing. However, as a rule of thumb, certainly in the past, it has been 5 to 7 is kind of the optimal quote-unquote number of span of control. But as I said, that varies based upon many different things. So that's the width. The organizational height, okay, is certainly affected by your span of control. If you have a narrow span of control, that leads to a taller organization, an organization that has to have many more layers in order for it to accommodate the number of employees that it has. And a flat organization is one that has few layers and a wider or broader span of control. And there's certainly been a move over the last 30 years to have flatter organizations and broader span of control. And part of that, it has to do with the technology. Part of that has to do with new management techniques and theories. So here's an example of a very narrow span of control with the span of control of 1, where the president has 1 person reporting to him or her, and then the vice president 1. This is a very, very narrow. It's the tallest organization you can have with 4 employees, while the one below, the one down here, has a wide span of control where you have all of the salespeople, all 6 of them reporting to the president. Structure can also be affected by centralization, and centralization is a concept where the authority is held tightly by a few people, and that the middle managers and the supervisors make few independent decisions. Decisions are held more centrally, hence centralization. Decentralization, on the other hand, is where authority is spread among more people, spread more across the organization, and where individuals and individual divisions and departments are more autonomous in their ability to make decisions. So that's centralized and decentralized, and it has an impact on structure, has an impact as well on the operation of the business. So here are some advantages and disadvantages of decentralization. You may think that decentralization is a good thing, and it can be, but there are also some disadvantages of decentralization. Again, may force some managers to make decisions, major decisions, although they lack the experience or prefer not to make those decisions. Assigning an excessive amount of responsibility to middle managers might make it hard for them to complete all of those tasks. Now, I think those are certainly disadvantages, but I think that in most cases we can overcome them by rules, procedures, processes, and just by, frankly, selecting the right people for those jobs. The advantages are often clear in that the reduced operating expenses, that people feel empowered by able to make decisions, or the fact that people who are closest to the information are the ones that are making the decisions. And so this delegation of authority also has an impact on the morale of the organization, and also increases the the decision-making skills across the organization. So when managers have the opportunity to be promoted or move into greater positions of responsibility, it's not the first time that they're making decisions, that they have some experience in making these decisions, so presumably the decisions that they make will be a little bit better. So let's take a break here, and I will see you real soon.